The AI revolution is well and truly underway. In 2024, global AI investment grew to around $252 billion and is projected to reach $3.5 trillion by 2033, even larger than today's automotive industry. Complex generative AI has only existed for a few years, yet it has advanced extremely quickly. Recent evidence shows that workers who actively use it save roughly 2 hours per week, and that it could raise annual productivity growth by up to 3.4 percentage points. I'll first look at how AI affects inequality within countries, and then turn to the more important question of how it is widening inequality between countries. The IMF finds that in the UK, AI affects inequality through two channels. In the wage channel, low-income workers see wage gains from higher productivity and output, while some high-income workers, such as programmers and data analysts, face automation risks and experience wage declines. This slightly reduces wage inequality. This pattern matches Acemoglu's finding that AI distributes displacement risk more evenly across education levels than earlier automation, which mainly affected lower income workers. In the wealth channel, the effect goes the other way. Although some high earners lose wage income, they own most of the capital, and because AI raises returns to capital, those invested in AI become much richer. But while these within-country effects matter, the bigger pattern is what's happening between countries. AI isn't spreading evenly, and that's where the real inequality risks lie. Research shows that AI is increasing income divergence between countries. Automation is most profitable where wages are high, which is why AI development is concentrated in advanced economies. The major AI firms, OpenAI, Meta, Google, are all based in the US, which invested around 12 times more than China in 2024. Because AI creates stronger investment returns, countries that build and adopt it attract large capital inflows, widening global wealth and income gaps. In the Solow Swan model, all countries share the same technology, so poorer economies grow faster and eventually catch up, convergence. But later work by Aghion and Howitt showed that in reality, technology access isn't equal. Countries closer to the technological frontier innovate faster because their growth comes from creating new technologies, rather than adopting existing ones. The United States is a clear example. Its strong universities, venture capital markets, and clusters like Silicon Valley mean it already operates very near the frontier. This makes it far easier for US firms to develop and scale AI, since they already have the skills, infrastructure, and research capacity needed. Countries further from the frontier grow mainly through catch-up, which means adopting technologies invented elsewhere. But AI is much harder to adopt than earlier technologies. It requires advanced chips, data centers, skilled engineers, and a large R&D budget. And this matters because it's deep adoption, not just surface-level use, that generates meaningful productivity gains. Many poorer countries lack these foundations, so catching up becomes much more difficult. This increases the risk that they fall into convergence clubs, where growth slows and the gap with richer, innovation-driven economies widens. So while evidence on within-country inequality is mixed, most research shows AI widening income gaps between nations because frontier countries can innovate while others struggle to catch up. Policies that improve access to chips, skills, and digital infrastructure would help more countries adopt AI deeply and share in its productivity gains.